This cycle turned over more than $15,000 combined in wins and losses. 17 wins, 7 losses, and 71% win rate. And at the end of all, he was left with just under $1,800 net. Today we're breaking down a real trading journal and showing why even a solid win rate doesn't mean a strong edge if your risk to reward ratio isn't right. This is Jaroslav from Czech Republic, trading cycle number 9 on EverTrader $100,000 account. He traded exclusively the Uzbek index, combining both long and short positions. By the end of the cycle, equity stood at $101,826 at 1.83% profit with a profit factor of 1.92. Total wins at $10,176, total losses $5,299. The gap between those two numbers, the net profit, is only a fraction of what actually got turned over on the account. And that's exactly the point where you need to stop looking at the total and start looking at the individual trades. Let's look at the best trade of the cycle. A long position on the named index opened on June 17th, closed a day and a half later. The stop loss was only 26 points away, the take profit was 616 points, and the risk to reward ratio of roughly 1 to 24 in the trader's favor. Shortly after entry, price brushed against the stop loss but never triggered it, then took off in the right direction. Jaroslav didn't wait for the full take profit, he closed manually, banking over $1,600, roughly 82% of the planned profit. This is the kind of trade that should form the core of any strategy. Minimal risk and significantly larger potential reward. And active position management instead of passively waiting for the outcome. Now, the trade that explains why the net profit stayed so thin. A long position on the same index opened on June 22nd, held over a day and a half. The profit loss 1,427 points away, the take profit just 390, a risk to reward ratio of roughly 3.5 to 1 against the trade. The exact opposite of the best trade in the same cycle. The market moved against the position for almost the entire duration. Jaroslav eventually closed it manually before the full stop loss could hit. A good call in the moment, but the loss was still 3,196. One single trade accounts for 60% of losses in the entire cycle. On the top of that, there's a second problem, position size. The typical trade in this cycle was 4 lots, but the position of 6 or 8 lots also showed up, with no obvious rule for when or why the size changes. Sometimes the larger position pays off, sometimes it doesn't, which is exactly why inconsistent sizing is hard to tell apart from luck. This is exactly why you can't judge a cycle's result by win percentage alone. The trading journal shows that 71% wins and 1.92 profit factor looks solid at first glance. But the real story is that one badly set risk to reward ratio is enough to wipe out most of what the other trades earned. EverStation Pro with TradingView integrated and the Analyst app added the context to see not just the outcome but how the trade was set up the moment you entered it. A solid win rate only protects you until the one trade shows up with the risk set against you. Edge isn't measured by how many trades you win, it's measured by how much you actually make relative to what you risk. If you want to see your own risk to reward ratio on every single trade, not just the total at the end of the month, go through the evaluation and open your own trading journal. We have a program with absolutely no time limit, so there's no need to rush. Links in the description in the bio. If you want more breakdowns like this from real trading cycles, hit subscribe and let us know in the comments whose journal we should break down next. See you in the next video.